When we think about money, it seems like something tangible. Paper bills, coins, numbers in an account. But what if I told you that most of the money that exists today has never been printed? That modern banks literally create money out of thin air, just by pressing a button. Let's take a look at how the banking system works and where money actually comes from. Banks are not just money storage facilities. They are intermediaries between those who save, deposits, and those who need money, loans. But there is one detail. The bank does not keep all your money in a safe, only part of it, and the rest is used for loans. This is called fractional reserve banking. Let's go back in history a little. In the Middle Ages, merchants, in order not to carry bags of precious coins with them, kept their money with jewelers and moneylenders. Over time, they noticed that the owners of the money did not take their money back for long periods of time. To prevent the money from sitting idle, they came up with the idea of lending part of it to other people at interest. This is how fractional reserve banking and the concept of modern banks came about. But there is one big problem. The bank wants to lend more money in order to earn more interest, but at the same time it needs to keep sufficient reserves in case tomorrow, for some reason, many depositors come to withdraw their money, for example, because they have heard about an impending war. A situation where a bank does not have enough money to return to its depositors is called a cash shortfall. If the bank cannot find the money, panic ensues, more and more depositors come to withdraw their money, and the bank goes bankrupt. The panic spreads to other banks, and they collapse as well. Examples include the collapse of the Bank of the United States in 1930, followed by 11,000 banks in the US, which triggered the Great Depression, or the collapse of Lehman Brothers and the subsequent crisis of 2008. In order to control banks and prevent crises, a bank of banks was invented, the central bank. In the US, for example, it is called the Federal Reserve. The central bank regulates what percentage of money banks must keep in reserves. For example, if the reserve requirement is 10%, banks can issue 90% of deposits as loans, keeping 10% as a reserve in the central bank. Banks that violate the rules lose their licenses. Let's imagine that you deposited $1,000 in your bank. The Federal Reserve has set the interest rate at 10%. Your bank lends $900 of your money to your neighbor to buy a car, keeping $100 in reserve as required by the central bank. After buying the car, your neighbor transfers $900 to the seller's bank. This bank, keeping $90 for itself, lends $810 to a person who intends to buy a mobile phone. After buying the phone, $810 goes to the account of the phone seller's bank, which in turn keeps $81 and lends $729 to the next borrower. And so on until the end, until the demand for loans ends. Thus, from the $1,000 that went to the first bank as a deposit, many times more money appears in the economy. In theory, a deposit of $1 can create up to $25. This is called the money multiplier. But in reality, for various reasons, this ratio does not exceed 1 to 3. This is why they say that banks create money out of thin air. The amount of money created in the economy depends on the fractional reserve requirement, as well as other central bank restrictions, which we will discuss later. If the economy is growing too fast, the Federal Reserve raises the fractional reserve requirement to prevent inflation from rising. Banks are forced to hold more money, and their ability to lend decreases. As a result, there is less money in the economy, people buy and produce less, and inflation falls. If the economy needs growth, the Fed lowers interest rates and banks issue more loans, increasing the amount of money in the economy and stimulating production and consumption. This leads to two key conclusions. First, money in the economy is created by private banks. The Fed and other central banks can certainly create money, but they do so only in extreme cases. Second, almost every second dollar in the economy is debt. Accordingly, no debt means no money and no growth. But in today's world, things are much more complicated. In the digital economy that emerged in the 2000s, money is just numbers on a computer. When a bank issues a loan, it does not give someone else's money. It creates new money. For example, you take out a loan for $100,000. The bank simply records plus $100,000 in your account. This money is not taken from other people's deposits, it is created at the moment the loan is issued. This is how non-cash money creation works, the basis of the modern economy. In essence, every loan is new money that comes from the obligation to repay the debt. In addition, in the US and other Western countries, the fractional reserve ratio is 0%, which means that, ideally, banks do not have to hold any reserves at all and can issue an unlimited amount of money using numbers on a computer without risking anything. Money out of thin air. But in reality, this is not the case. In the modern banking system, there are two new restrictions for banks: capital adequacy ratios and liquidity ratios. CAR determines how many loans a bank can issue based on the degree of risk of the loans and the amount of the bank's own capital. Let's imagine that your bank has $1 million in equity capital. The mortgage loans that the bank intends to grant are considered high risk, so the CAR will be 10%. This means that the bank has the right to lend only $900,000 for mortgage loans and is required to keep an amount equivalent to 10% of its capital in reserve in case of trouble. Liquidity ratios determine how much liquid money the bank must have in reserve in case of a run on the bank. In other words, the bank must have enough real money, cash, government securities, or reserves at the central bank to be able to cope with a 30-day outflow of deposits. All these restrictions force banks to have enough real money in reserve and to minimize risks when issuing loans. Thus, even with virtual money and computers, banks cannot create an infinite amount of money, despite the fact that they are no longer required to hold reserves at the central bank, as was the case in the last century. Today, private banks voluntarily hold reserves to meet capital adequacy and liquidity ratios. Private banks make a huge number of money transfers every day. For example, when customers transfer money to another bank's account. This reduces the bank's reserves. As we mentioned earlier, according to CAP and LR requirements, a bank must always have sufficient liquidity and equity capital, and if the bank's reserves are insufficient, the bank is required to find money to replenish its reserves in order to meet the requirements. It is for this reason that banks lend money to each other at interest rates almost every day. This is called the overnight rate. When a central bank, such as the Federal Reserve, believes that a country is threatened by inflation, it takes steps to raise the overnight rate. This is called the federal funds rate. Using monetary instruments, the Federal Reserve raises the interest rate at which banks lend money to each other. If, for example, the overnight rate is 3% and the Fed raises the federal funds rate to 5%, the overnight rate will eventually rise to 5% as well. As a result, borrowing money will become more expensive, so banks will reduce their lending activity to avoid a decrease in reserves. This slows down the economy and reduces inflation. If the Fed needs to stimulate economic growth, the federal funds rate is lowered, money becomes cheaper, banks are more willing to lend each other, businesses and individuals, there is more money, and the economy grows.